Welcome to Inside India. I'm Emily Tan, sitting in for Sri Jegarajah this week. Here are your headlines. President Trump teases a potential trade deal with India as the July 9 deadline looms. But word in New Delhi is that negotiations have hit a wall. Investors signing up for India's biggest listing of the year, HDB Financial Services' $1.5 billion IPO, fully subscribed on day 2 of bidding. This as India's Nifty extended its winning streak for a third straight day, still holding above that key 25,000 handle. Happy Friday, a very good morning. Let's start off with a look at the Asian markets here. And we had a positive lead coming through from Wall Street, and it's looking pretty okay out there. Fractional gains coming through. The exception is the Nikkei 225 standing out 1.5% at 40,215. Korea, Shanghai, and TAIEX all pointed to the downside, but just fractional gains there. A couple of markets, Indonesia as well as Malaysia, shut for a public holiday. The Indian markets come online in about 45 minutes, and here's what Gift Nifty futures are indicating. We've got some upside, up 0.1%. The Nifty 50 will start this morning at 25,549. Of course, we are going to be watching out for levels because we are within range of record highs. The Nifty saw a 304-point surge in yesterday's session and inching towards an all-time high. We will keep our eyes on those levels when the market opens later this hour. In terms of sectors, metal, oil, and gas, financials seeing their biggest gains and fueled the index's uptrend on Thursday. A quick check on the U.S. dollar index. It's continuing to lose steam, and it hit 97 overnight. 97.28 last traded. We're looking at, of course, the levels, the lowest in over 3 years. Currently, it's traded higher by 0.1%. This as markets priced in the likelihood of the Fed cutting rates more than expected. Reports also emerging that President Trump may bring forward his announcement of a replacement to Fed Chair Jerome Powell. Trump overnight saying a person at the Fed lowering interest rates would help.
And if we had a person over at the Fed that would lower interest rates a little bit, that would be helpful too. It's hard to believe. This is on top of, we have to fight this guy. He's not doing the job. Each point that he keeps it up is the equivalent of $300 billion. $300 billion. So if he lowered it to, it would save $600 billion. We have to work hard with cuts on that, right? That's a lot of cutting. And this guy could do it so easily. We don't have inflation. Well, we might have inflation. Yeah, and if you do, you raise the rate a little bit. That's okay.
Our U.S. colleague spoke to Chicago Fed Chair Austin Goolsbee about threats to Fed independence.
Hopefully, it has no effect. As you know, economists are basically unanimous on the importance that central banks be free from political interference when setting monetary policy. And the reason why economists are unanimous about that is if you just look at places where they do not have that, inflation is worse, growth is worse, unemployment is higher. I think it's a mistake if we're going to start messing with the political interference part.
And on to India's biggest public offer so far this year. Investors flocked to buy HDB Financial Services' $1.5 billion offering. The IPO was fully subscribed on day 2 of bidding. The take-up among institutional investors was more than double their allotted portion, 60% among retail investors and 90% among qualified institutional buyers. The company is the non-banking financial services arm of India's biggest private lender, HDFC. HDFC Bank holds a 94% stake in HDB and is selling shares worth 100 billion rupees in the public offer. Shares will start trading on July the 2nd. And more activity in the IPO market. Another non-banking lender, Credila, filing for a $584 million IPO. The company offers education loans and is planning to use the money raised from the IPO towards raising its capital base. The public offer will be a mix of fresh issuance of equity shares and offer for sale by existing shareholders. Meantime, fintech firm Pine Labs is also eyeing a public listing. Reports say the initial public offer could be worth $1 billion, which would value Pine Labs at around $6 million. The payment services provider is looking to use IPO proceeds to strengthen its international units and cut down its debt. Pine Labs is backed by the likes of PeakXV, PayPal, and MasterCard, and they will be looking to sell their shares in the company when it IPOs. Dhirendra Kumar is the founder and chief executive at Value Research and joins me now to talk more about the IPO space. A very good morning, Dhirendra. We're seeing a little bit of a pickup in the IPO activity. There's 6 book building exercises currently taking place. Give us an assessment on what you're thinking. Is this the start of something more?
No, this is just the beginning and it's ongoing. And I think, it's getting into the last lag because investors were pouring money, they're buying into it, but the numbers are very much against what is going on. In fact, you were talking about in your news update, you're talking about HDB Financial Services. This is a company promoted by HDFC Bank. 6% of the stock is still in public through employee stock option, which has found its way. So there is a fairly reasonably active market in the informal market, even before listing. And just about a week ago, the fairly active informal, or you can call it the gray market, price was 1,400, and the prospectus is, the prospectus price is 700 to 740. So people have got a haircut even before the issue. Yeah, if you look, and that is 6% of the company. It is not something which is the periphery. If you look at the post-listing pop and what happens a year later, there is virtually no correlation, 1.1%. So there is a possibility that, and investors are trying to figure out, investors have figured out to an extent, and that kind of objectivity will become visible. It looks like greater fool theory is at work, and investors are likely to be, and we have seen it in the number of IPOs so far, where venture capitalists and IPOs, not much money is actually getting into the company. And if it's not getting into the company and the long-term prospect is still blurred, it is just finding an exit route. Things look very grim. I don't know how long will it last. This is actually a musical chair where you don't know when the music will stop.
Don't know when the music will stop. Okay, that's not what I was expecting to hear. So what will this mean for when HDB actually does come online? We're looking at a July 2nd debut into the market. This is the biggest IPO in India so far this year. So that should be encouraging to the market, no?
No. In fact, what has happened in the market is people have bought this stock for 1,400 and the IPO listing is going to be at 750 or maybe it's a little premium. It is unlikely to double on listing. So it is going to be, even the people who there is an element of lottery in any IPO. When somebody gets allotted, they think that they can exit, staggering on listing is a very normal thing. People are, you don't attract long-term investors in the IPO, which is where a lot of investors pour their money. So with that, and the scale of this IPO is something which makes me think that, investors, even if it trades at 10% premium to its listing price, more investors will be disappointed than pleased.
What about the pricing of the shares? Is this the issue? There is the private market value of a company, and then, of course, a disconnect when the shares actually start trading in the secondary market.
No, it is actually a demand, supply, and the pricing. Combination of these two. And pricing seems fair because, HDB Financial Services coming from or promoted by HDFC Bank has all the hygiene or, very nice variables in place. And I don't think they are, and with financial services company, or particularly the non-banking financial services company in India, you always take numbers with a pinch of salt, sometimes with a fistful of salt. But in this case, the numbers could be very credible going by the genesis, going by its, parentage. But just because 6%, it's a very actively traded stock in the gray market, and 6% of the stock is a sizable one. So it's bound, and it is unlikely to double on its listing. And so my sense is that it could be a great long-term, it can have great long-term prospects, but purely based on IPO and listing and, even interesting, little gain, it is not likely to impress or please investors or likely to keep the IPO momentum alive.
So what will this mean for investors that are looking to try and exit their investment via an IPO?
No, those people are done. On day 2, the issue got oversubscribed, and HDFC Bank wanted to sell it. So this was a slightly different thing, as compared to most other IPOs in the pipeline. HDB Financial Services, where the lead seller is HDFC Bank, and there is a preferential allotment mechanism for the existing shareholders of HDFC Bank, which is huge, and it is a large bank, large number of shareholders. In fact, the largest private sector bank by capitalization. So this has been able to sail through, but all other big companies in the pipeline, where the venture capitalists and the private equity funds are queuing up to hawk their shares, they might be in for surprise.
I'm looking at here some data from the Securities and Exchange Board. They're saying that over $12 billion worth of IPOs have been cleared by the exchange. There are 130 companies in the wings waiting for a listing. So in the environment that you're talking about now, what should investors do?
They should be extremely selective, and they should look at it from a point of view that, when a company comes up with its IPO, there is a degree of element of lottery. You have a very big investor trying to time and trying to hawk and set a narrative for the company, trying to build a market for this company. Remember all the issues. The biggest story of recent times is the Paytm, the Indian fintech, where, or look at Nykaa, another company where it started, the listing price was at a 33% gain. And in fact, on the day of listing, Nykaa crossed the market capitalization of India's third largest refinery, Bharat Petroleum. And now we find that, though it has come down by nearly 66% from the listing price, I think, this company, based on what it does and the scale of numbers and the profitability and the outlook, and despite the India story of, every Indian woman will aspire to get, cosmetics at home, and there's a huge market, and this company will dominate the market. Still, I feel that, this company should be at 1/6 the value than what it is today. So don't buy into the story. Ask question. Think like a long-term investor, because you just might be the last person who bought into the story, and you might have to clean the mess.
How would you recommend for retail investors to be managing this? There's many apps that they can use to participate into the market. What would your advice be to retail investors?
Generally avoid most of them, and don't be the last one. And you are against a very big investor and a management. There is another characteristic of most of these companies. The money that you are going to put is not going into the company. The money that you are going to put is going to another investor who bought it at the outset of setting up of the company, and he has taken all the risk, and he is trying to give you the stock in anticipation of the future, rosy picture that is getting painted. One is that I would urge every investor to look at numbers, that if you don't have the numbers, if you don't have profits, just skip. Avoid. Even if you miss out on a big opportunity, it is better to miss out. Maybe most individual small investors who are just getting attracted and getting into IPOs as if buying a lottery ticket, they will do well to avoid most of it. It is very important for beginners first-time investors. There are a large number of investors who get attracted to the market only through the IPO. For them, it turns out to be a disaster because you start, you lose, and you go away swearing never to come back again. And that is disappointing. Market is a great place to be in a methodical way, start with a diversified mechanism, portfolio, start your SIP. Once in a while, you can also look at some IPO once you have built up something. Be interested, think long term, maybe in the short run, if you get lucky, feel happy about it.
What do you say to startup companies that are still loss-making but want to go to market? What would your advice to them be?
Get your act together. Businesses are, there to make money and share it with shareholders. Don't sell stories. Manage your company well. And, all the large ecosystem or the IPO or the government backing or the sponsorship or, some degree of, enthusiasm around IPO and new technology companies, I really don't see a groundbreaking, there are good entrepreneurs. They have done a good job. They are enterprising people. They are managing, they are growing. But making money is an essential part of a business to be sustainable. When I look at, India's flagship, the Flipkart sold off to Walmart and is still way off from making money. And it is now a 20-year-old story. So I think don't try to, I would say that the truth will come to haunt you.
What about SPAC listings, a special purpose acquisition company? How soon or when do you think the Indian market would allow something like this?
I don't think Indian market should ever allow, because, going by our history, we should not forget history. Not very long ago, we had a case, joint parliamentary committees was set up about 10 years back to figure out, there were companies which raised money and they disappeared. They just simply vaporized. They were traceless. And there are still, there's a list of companies on SEBI, which is called vanishing companies. And we had the IPO laws reframed to take care of this menace of promoters coming, raising money, and then disappearing. I don't think we are going to give a blank check. We are going to enable a blank check company. Not very long ago, it was not possible for loss-making companies to come up with their IPO. That, I think, itself looks like a big concession.
Dhirendra, thank you very much for talking through the IPO space in India with us. Dhirendra Kumar from Value Research. Thank you. Coming up, the July 9 tariff deadline is approaching fast. We will get you the latest on all the trade deals that are in the works. Ahead of that, stay tuned. Inside India, we'll be right back. The impact of China's rare earth export curbs is echoing across the world, including in India, where automakers flagged how the sector is being affected by it. But the U.S. has found a workaround as part of the trade deal agreed upon last month in Geneva. The U.S.-China deal includes an agreement on rare earths and expediting its exports from China to the U.S. U.S. Commerce Secretary Howard Lutnick telling Bloomberg that America would take down its countermeasures as soon as China delivers its rare earths. The EU is assessing its options on a trade deal with the U.S. The bloc's leaders meeting in Brussels on Thursday, where they discussed proposals from the U.S. No further details were given on the U.S. side. But the big question for Europe is if they should push for a quick trade agreement or keep trying for a better deal. The bloc's two biggest members at odds on this. Germany wants a quick deal, while France wants the same. It won't accept unfavorable terms. Von der Leyen not ruling out talks with the U.S. could still fail.
We are ready for a deal. At the same time, we are preparing for the possibility that no satisfactory agreement is reached. This is why we consulted on a rebalancing list, and we will defend the European interest as needed. In short, all options remain on the table.
Meantime, Reuters is reporting that there could be roadblocks in the trade deal between the U.S. and India. Citing sources, Reuters says there are disagreements on import duties for auto components, steel, and farm goods. But local media reporting say an India delegation has already reached Washington to resume negotiations. President Trump also saying a trade deal with India is maybe coming soon.
We're not going to make deals with everybody. Some we're just going to send them a letter, say, thank you very much. You're going to pay 25, 35, 45%. That's the easy way to do it. And my people don't want to do it that way. They want to do some of it, but they want to make more deals than I would do. But we're having some great deals. We have one coming up, maybe with India, very big one, where we're going to open up India. In the China deal, we're starting to open up China, things that never really could have happened. And the relationship with every country has been very good.
Auto and steel tariffs are also on the agenda in U.S.-Japan trade talks. Kaori and Joji joins us now with more. Kaori.
Thanks, Emily. India, China, the EU. Are you noticing a pattern here, Emily? Because the trade negotiator from Japan is back in Washington for the 7th time. As of yet, we still don't know when or if he is going to get FaceTime with the lead negotiators on the U.S. side, particularly because they're being bogged down by the events over the last week, in particular in the Middle East. And July 9th, everyone thought that is going to be the end of the pause, but apparently not. Take a listen to the press secretary from the White House.
The deadline is not critical. The president can simply provide these countries with a deal if they refuse to make us one by the deadline, and that means the president can pick a reciprocal tariff rate that he believes is advantageous for the United States and for the American worker, and he will continue to do that.
It is critical for the Japanese auto sector if tariffs are going to go up from 10% to 24%. And the Japanese negotiator has said time and time again that this is the sticking point for Japan. They wanted to initially propose a package, but it was clear when Prime Minister Shigeru Ishiba met with Donald Trump at the G7 that there was nothing of the kind yet on the table. Akazawa left for this meeting and said the same thing he did last time. That is, he is still in the fog. That does not exude confidence, especially for a man who met with the chairman of Nippon Steel, who inked that deal with U.S. Steel, to see if he can glean some pointers, negotiation tips on how to wrap up a deal. I think domestically, Japan is in a tight spot as well, because campaigning begins next week for critical elections that are coming up. The LDP faces an uphill battle in that. So in terms of the timetable, it's getting increasingly difficult to Japan to spend even more time on trying to map out a workaround for these tariffs. Emily?
Kaori, thank you very much for giving us the latest on U.S.-Japan trade. Kaori and Joji in Tokyo. And staying with Japan, the country could be facing energy shortfalls down the road, according to the Grid Monitor. Lin joins us. And Lin, what is Japan doing to address this?
Hey, Em. Well, Japan is trying to basically ramp up the idle capacity that exists when it comes to its nuclear energy. And earlier this year, the government had put out a revised version of its energy policy, the first time in 3 years. And basically what they're hoping to do is to move that reliance up from about 8.5% to 20% by 2040. And in the document, they also dropped the words minimise reliance to maximise reliance on nuclear as well as other renewables. But it is a tall task ahead, given the deep public mistrust and the fact, of course, that Japan has lived through these catastrophic nuclear events. Earlier, we spoke with Nobuo Tanaka, who was a former executive director of the IEA, and this is what he had to say about what needs to be done to turn things around.
We have to show the kind of vision for the long-term nuclear power, which I am promoting, how to make the nuclear sustainable after the Fukushima. Safety is the issue. Another one is how to take care of the high-level waste, radioactive waste. We don't have any clear plan of disposal. So the first thing, we have to establish the place to dispose or new technologies which can make it much easier. And we have to take care of the meltdown debris of the Fukushima. And this is just very much same thing as a high-level waste. So without clear solution for that, I don't think Japanese public can be more affirmative about the future of the nuclear.
So it's a very delicate balancing act when it comes to Japan's energy complex, and highlighted by the fact that the expectations around energy demand is only set to grow. We know that Tokyo is trying to continue to court companies like TSMC to produce in the country. And today we've been hearing from Masayoshi-san of SoftBank Group. He's been speaking at the AGM talking about SoftBank's goals to become #1 in a decade in artificial super intelligence platform provider as well. Anne.
Lynn, thank you very much for that. Coming up, markets in India seem to be regaining momentum, and IPO activity is coming back to the markets along with foreign investors. But is this sustainable? We'll discuss next with Radhika Rao of DBS Bank. Stay tuned. Checking in on Asian markets, a positive lead from Wall Street, but it's looking largely mixed across Asia, with the Korean Kospi, the biggest loser on the board, down 1%, 3,049. The Nikkei 225, though, advancing 1.5%. The TAIEX down 0.25%, and the Hang Seng Index just with a slight positive bias. A couple of markets out of action today for public holidays include Indonesia and Malaysia. We are counting down to the market open in India, and this is how it's looking ahead of the open. We've got Nifty futures just with a slight positive bias. The Nifty 50 at 25,549, and it has been on a winning streak since the last 3 days and now inching towards an all-time high. We will be watching those levels when the market gets up and running today. Radhika Rao is a senior economist at DBS Bank Singapore and joins us now to talk more about the Indian markets. Radhika, good morning and thank you for joining us today. Just give us a breakdown of what you expect to be driving the Indian market. So we've been up for a couple of sessions. It seems like the ceasefire in the Middle East is holding. What is driving the market?
Hi, morning, Emily. Certainly, I think there is, the markets in general in India have kind of, I would say in part, moved away from what's happening globally. Even when the geopolitical risks were, high, you did see some amount of resilience in the domestic markets. And now when there are signs that the ceasefire is here to stay, certainly for the equity markets at least, you have really seen a big jump. And I think what we need to remember also is that, and this is something that's been happening for the past 3-4 years now, is that even when you see a higher volatility in foreign flows, you have a big counterweight by way of the domestic investors, especially retail investors as well as institutional investors buying a lot more. So kind of counterbalances the effect. So I would think, to your point, an ebbing geopolitical risk scenario certainly adds to the tailwinds that the Indian equity markets in particular, as well as the currency, in fact, sees. And you've seen, thanks to the dollar pullback, that the dollar rupee or the rupee itself has strengthened past 86 back into the 85.50 handle.
But we are not far from all-time record highs for the two major benchmarks. Do you expect the levels to reach? Do you think the Nifty 50 can get there?
I'm not an equity analyst, but I would think that if you were to go with the momentum at this point and the kind of resilience that the equity indices have shown, that these record levels might be within reach. And again, it is a function of global as well as domestic catalysts. And when you see the domestic catalysts, there are positive signs. Inflation has come down a fair bit. The central bank has cut rates by about 100 basis points. There's a bit of a split consensus on whether they're going to do more or not. But it's quite clear that they are pro-growth. They want to be growth supportive, provide ample liquidity. All of that is certainly translating into a positive macro environment for the markets to operate in. And globally, if you're really seeing this big reshuffle from away from DM and US in particular into emerging markets, which I think will get a further tailwind, because if dollar continues to correct, I think all of this certainly bodes well for the Indian markets as well. So I wouldn't be surprised if the record highs, come into view again. Certainly the momentum seems to suggest that.
I will get to your economic expertise, but just one more on the markets here as we're seeing a flurry of IPO activity. We were talking to another analyst earlier, but HDB Financial, there's been oversubscription. The books are still open today for one last day. What do you make of all this IPO market activity? Could India go back to what we saw last year? It was something like over 300 IPOs that hit the market. Could that offer support?
In any economy, you generally do see better faring capital markets, kind of providing a good support for corporate intentions, especially if they wish to borrow and move away from debt and into equity. So it was a very busy 2024. Just as you mentioned, we do think that 2025 started on a slightly tepid note, given what was happening globally, but the interest seemed to be coming back. I mean, the IPO that you mentioned in particular is of significant size, so it will certainly impact the market. but I wouldn't think that this is the last that we're going to see. A lot more, companies seem to be in the pipeline. Of course, the regulator also tends to scrutinize quite closely because you've had some names which have performed well at the open and thereafter not so much. Some that have really didn't have much of I would say, a strong business case. So those kind of companies will also be under scrutiny. But I would generally think if markets continue to behave the way they are, that wouldn't stop corporates from attempting to, try and enter the stock markets as well as this particular one has done at this juncture.
We've heard from the White House that this July 9 deadline it's movable or it is flexible, and there are some deals in the pipeline, according to President Trump, as many as 10, and including that of China. Where do things stand in terms of India? Because there have been some roadblocks that we've been reporting about between India-U.S.
Yeah, certainly the whole situation is quite mercurial. We are fast approaching the 8th of the July or 9th July deadline. And Asia markets, especially ASEAN and India included, are watching this quite closely. India was one of the forerunners. I would say back in February, we had Prime Minister Modi, meet up with the U.S. counterparts, and the discussions had begun back then, even before the reciprocal tariffs were out in full force. So we do think, directionally, it does seem quite favorable. Both the sides have been deep in discussions. But of course, there are some contentious issues. India does want to provide concessions, but there are some segments, particularly farm goods, for instance, where I think the entries to barrier can't be lowered too fast. Even for some of the sectors, the Indian businesses or Indian authorities prefer to have a more level playing field. So I don't think they will open up the sectors completely, according to at least what the US might ask. So I think there is still a bit of give and take that still needs to be thrashed out. But given the amount of effort that's gone in, the duration that discussions have been going on, we wouldn't be surprised if India is among the first few, next batch, first few countries to sign the deal. And most, as we have seen in some of the trade deals that have already been announced, or trade agreements that have been announced, it seems to suggest that the details are always thrashed out after a point in time. And overnight you heard about India, US and China also penning down some of the discussions they had back in Geneva. So I think the details will be very important as well for both sides. But there could be a scenario where you have the first phase out now, and then details continue to be thrashed out for another 6 to 8 months. But we remain, optimistic that this is likely to be, especially before the upcoming fast approaching deadline for the tariff announcements.
Prime Minister Modi has tried to position India as a key partner to the U.S., wooing companies like Apple to boost investment and production as part of a diversification away from China. But Trump, on his part, doesn't want to see iPhones made in India. So what kind of dilemma is there?
Yeah, this, India has managed to attract a fair amount of, I would say, diversification flows, right? This started about 7-8 years back when Apple and some other companies as well had started to explore the option of producing somewhere else other than just China. So look at the region as a whole, and India did stand out, because of the consumer market it offers, also because of its interest in attracting more manufacturing names. So I think electronics, especially smartphone manufacturing assembly, has been a very big sector that has benefited from this entire push. Of course, U.S. comments and the government's comments are very important to watch, but I don't think this is going to really derail the kind of movement that these investments have done. In fact, anecdotally, there is also this conversation that the companies that are operating, especially the bigger Apple suppliers that are operating in India, could move beyond just the smartphone and also speak about enclosures or mobile chargers, try and do the peripheral assembly as well, which essentially helps because that really builds the ecosystem. And as we know Now, supply chains of this sort really require a lot more parts to be function and the ecosystem to be up and running. So that's a positive sign. So I would think this push is likely to continue and move beyond just electronics into more renewable. We have already seen some auto ancillary units as well. Apart from IT hardware, for example. So we think this move into exploring India as an alternative supply chain participant has already been set into motion. We do expect further developments and further improvements here on.
As we've heard from our reporter in Japan, they've had 7 rounds of talks with the United States. For India, they've had at least several rounds of discussions. Do you think it would require Prime Minister Modi to get involved, like what we've seen with President Xi and President Trump having to have a phone call and then, of course, things coming into place and happening very quickly? Do you think the Prime Minister of India needs to get involved?
These kind of discussions, certainly, I think the ball is in both the government's courts. At what point which person of authority gets involved. But I would really think what is very important is the nuance or the nitty-gritties of the trade deal. We should remember this is not an FTA. Free trade agreements then have a lot more depth. They have a lot more discussions on segment-wise, what are the concessions that are going to be given. This is more a trade deal where it's going to be a moving target in the sense that you're going to have a few phases of these discussions that are going to be ongoing. But I think the choice of who gets involved at what point is certainly left with the authorities concerned. But I think I wouldn't be surprised if there is, again, an initial announcement and then you see the details being built on over the coming months. And I don't think, we did hear the press conference where the US mentioned that all markets or all barriers of entry is going to be lowered, import tariffs are going to be cut across the board. I do think there'd be some differentiation when the details come out, especially for things like farm goods, for things like auto sector, and few others. So the details will really be very important again. And I think, certainly it'll be good to see if the initial phase is concluded by the time we are in early July.
We were watching the currency, the rupee, earlier on in the week. The weakness, whether or not it would crack 87 and whether or not that would spur an intervention by the RBI. Talk us of what your expectations are the currency, given that it is now supported by weak U.S. data and some expectations of rate cuts from the United States.
If you've seen the dollar rupee in the past 3-4 years, for instance, you've really seen quite a narrow band of action. The currency has had a tendency to move relatively more towards the weakness, part of the band rather than appreciate, even though its flows were very strong, and you've really seen, general sentiment being positive around the economy as well. What you've seen this year, since I would say late last year or late 2024, is that the rupee is reacting a lot more to general drivers, right? So in case there are episodes of dollar strength, you've actually seen dollar rupee react and adjust up. If you've seen weakness in the dollar rupee has reacted as well. So there are a lot more two-way volatility that we have seen in the currency, and I think that should be the case because then that certainly helps companies in general to build in their risk management strategies accordingly as well. Now speaking about what we expect of the dollar rupee this year, our FX strategist is of the view that kind of confidence crisis has and what the macro data is showing is likely to hurt the dollar a lot more this year. According to our core baseline view, the dollar is not corrected all the way, at least till what we expect, which also means that the Asian region in general and rupee in particular also has some more room to strengthen during the course of this year. So we do expect the dollar rupee to move below, dollar rupee to move below 85 or rupee to move above 85 into the 84 handle by the end of this year. So I think the trend is generally going to be two-way volatility, a lot more allowing the currency to adjust to what's happening in terms of catalysts, global as well as domestic. And as a trend, we have a stronger rupee view by India. Going very quickly on your inflation and rates point, certainly the central bank has opted to front load the rate cuts this year. Not only that, they have also maintained a pro-liquidity kind of stance, wanting to make sure that price of money and volume of money is not an impediment for the banks and the banking system as a whole. And I think that's, again, a profile that's going to continue. That generally bodes well for the macro environment and by extension, the asset markets as well. So I think, again, are they going to cut more? I think the consensus is divided. We are in the camp looking for, a pause, an extended pause from here. Only if growth really surprises on the downside, we think that they could build on more rate cuts. Apart from that, they've already reacted enough for a favorable inflation backdrop. We do expect rates to stay on hold.
Radhika, thank you very much for that. Radhika Rao from DBS Bank, Singapore. A quick check on cryptocurrencies. As we zoom in on the space, we're looking at Bitcoin, 107,515. Ether traded at 2,446. This as we're looking at Bitcoin holding well above 100,000 despite the 12 billion in inflows from ETFs this year. Bitcoin gains aren't as much as you'd expect. CNBC's Tanaya Machil explains what could be behind that.
Bitcoin ETFs have collectively seen about $3.5 billion in inflows this month and are on pace for their 9th week of inflows in the last 11. That underscores the strength of institutional demand we've been talking about all year, even amid market uncertainty. And yet, Bitcoin is only up about 2% this month. We know who's buying: Bitcoin ETFs and corporate treasuries. There's a fair amount of selling taking place as well that's almost perfectly offsetting all the buying and keeping the Bitcoin price stuck. And it shows a real change in ownership in the Bitcoin market. Now, looking at data from CryptoQuant, we can see that early mega whales, which are likely Chinese miners that acquired before 2014, have been holding on to their coins for longer and waiting to offload them in greater amounts to today's biggest Bitcoin buyers. The smallest wallets hold 1 to 1,000 coins. Institutions via Bitcoin ETFs tend to fall into this category. But if you look at wallets holding 1,000 to 10,000 coins and wallets holding more than 10,000 coins, they've been selling this year. Retail investors have also been sellers, although that cohort just isn't big enough to move the needle on price anymore. So that's one reason the Bitcoin price is stuck, and it could mean we see traders adopting more sophisticated options-based strategies or turn to proxies and treasury companies for their Bitcoin returns. For CNBC Business News, I'm Tanaya Machil.
Indian markets have joined the trading day, and we will look at some of the top market moving stories in Mumbai after this short break. We'll be right back. Indian markets coming online, and the Nifty 50 traded like this after 3 days of gains. We're tracking higher, 0.2%, 25,596, and the Indian rupee at 85.49. Let's look at some of the movers in the Indian markets today. Shares of Maruti Suzuki is traded higher, 0.5%, 12,778. The Indian government is considering a relaxation in fuel norms for small cars after lobbying by Maruti Suzuki. But Reuters reports that the other car makers in the country are opposing this plan. Maruti's business has taken a hit as consumers prefer SUVs over hatchbacks. The passenger vehicle market overall is seeing sales slowing in the affordable four-wheeler segment. Meantime, the latest on the Middle East. Iran's state media outquoting the foreign minister as saying there have been no discussions on resuming nuclear talks with the U.S. next week, contradicting President Trump's remarks that there would be discussions with Tehran. His remarks come after the country's supreme leader issued his first public remarks since the U.S. attack on its nuclear facilities, saying the U.S. has actually achieved nothing. Here's part of what he said.
The Islamic Republic delivered a hard slap to the face of America. It attacked one of America's key bases in the region, Al Udeid Air Base, and inflicted damage. The same people who had exaggerated in that previous case tried to downplay this one, saying nothing had happened, while in reality something significant had occurred. The fact that the Islamic Republic had access to important American centers in the region and can strike them whenever it deems necessary is no small matter. It is a major development, and this is an event that could very well be repeated in the future. If aggression occurs, the cost for both the enemy and the protester will be certainly high.
Elsewhere in China, India refused to sign a joint statement at the Shanghai Cooperation Organization. India's Defense Minister Rajnath Singh reportedly calling the statement pro-Pakistan because it did not mention a terrorist attack in April in which 26 Indian tourists were killed. This was also the first encounter with his Pakistani counterpart after the military conflict between the two countries. Before refusing to sign, Singh called for multilateralism to help prevent conflict.
India believes that the reformed multilateralism can help build cooperation to prevent conflict between countries by creating mechanisms for dialogue and collaboration. No country, however, large and powerful, can manage alone. In fact, the very idea of the global order, or indeed of multilateralism, is the assumption that nations have to work with each other for their mutual and the collective benefit.
A quick check on spot gold and losing some shine, down almost 1%. 3,295 investors have been finding comfort in safe havens amid the volatility of stock markets. The yellow metal on a tear, hitting record highs this week before taking a breather. But it's not just digital gold or ETFs getting love. Investors are going old school with physical bars. While India is repatriating its gold stored overseas, the Shanghai Gold Exchange opened its first offshore gold vault in Hong Kong. They're not the only ones in the vault game, though. There's one in Singapore in the Lion City. Let's take a look.
Physical gold bars, the asset of choice for many of the world's wealthiest. Not for returns, but for control. Holding the metal itself will not protect you from price swings, but it will shield you from someone else defaulting. But where are the rich parking their gold? For many in Asia, it's inside these doors. I'm inside the Reserve in Singapore, a 6-story, ultra-secure facility that can house up to 10,000 tons of silver and up to 500 tons of gold. That's about half of what central banks around the world bought last year, all under one single roof.
So we have 15 gold vaults. We're in one of them right now. And we can store around 60 tons in this gold vault. In total, we have a capacity of about 500 tons. Currently, we're using around 3% of the capacity.
Gregory Gregerson is the CEO of the Reserve. The company has made a bold bet on bullion at a time when gold has been smashing record highs and investors have been seeking safer bets. So this surge of new clients, where are they coming from?
Well, most of our clients are coming from the English-speaking countries. So United States, Europe, Australia. And a lot of our clients tend to be wealthy entrepreneurs because these are the people who made their own wealth, they're interested in what's happening in the world, and they tend to sort of take a chance on a new name as opposed to a big established bank name.
The world's biggest gold bunkers still sit in New York and London, but new facilities are emerging, from JP Morgan's massive silver vault in Britain to depositories in New Zealand.
There's no income from holding physical gold, and storing it comes at a cost. But it's protected from market crashes, bank failures, and bad debt. No counterparty, no surprises, just metal.
But why store gold in a private locker and not a banking system? Or invest in ETFs that are linked to metals?
Most banks are no longer in the business of storing gold. Usually what you will buy through a bank will be a price exposure of gold, but you won't get the physical. When it comes to ETFs, the gold will be stored, but usually you're not able to take delivery of it. And so our clients are looking for a solution where you actually can have ownership of a specific bar, you can take delivery of that bar, and you can do audits on demand.
And while 100 feet of steel and concrete may seem a bit excessive, for the ultra-wealthy, it's not just about storage, it's about certainty. In a world of market shocks and bank failures, sometimes peace of mind is measured in metric tons. For CNBC in Singapore, I'm JP Ong.
That gold bar looking pretty heavy, 1 ingot, equivalent to 12.4 kg. So that's all the time we have today on Inside India. Happy Friday. Keep it watching here on CNBC because Access Middle East is coming up next.